Have you ever received an investment overview for a private equity deal but didn't really understand how to read it and understand what is really going on? My name's Jeremy Mercer. I'm the CEO of Matador Capital, and I run private equity investments specialized in industrial assets in the Texas and Oklahoma markets, and I'm going to show you today on how to read an investment overview. So if you haven't really ran your own acquisition deals before, you might not completely understand what the investment overview is telling you. So today we're going to go through one of my sample investment overviews so that you have an understanding of what every part of it is telling you. The first part to go through is the sources and uses. And so for sources, what that really means is where's all the money coming from to do this deal? So in this example here, we're talking about a $2 million acquisition. So as you can see here in this deal, about 35% of it is equity, which I raised through my investment partners, and then the balance of it is debt, which will go out and obtain a loan with a lending institution. So those are your sources. So the sources of the money to go pay for the property then falls into the uses. The uses is what you are going to use the sources for. So you can see in this one, we have due diligence cost of around $10,000. We have an acquisition fee of about $42,000. So if you look in this investment overview, you can see the sources matches the uses on total sources and total uses. So that way you know where's the money coming from and what's it going to pay for. A second part in this investment overview to review is the stabilized pro forma. So you need to understand what the return is going to look like once that property is stabilized. And so that means there is some things that need to be done to this property to get it where it's in a rentable condition and cash flowing. This property, once stabilized, we projected is going to have a certain rent on it. So you have, in the first table here, you have the gross rental income, total of $222,000 a year. Now, off of the gross rental income, there is going to be operating expenses that come out of that number. So that gives you total expenses of about $52,000, which the 52 from the $222,000 gives you a net operating income of $170,000 a year before debt service. So we will be stabilizing or having this property where it's paying rent at an 8.95% cap rate. If you don't understand cap rate, go look at some of my previous videos where I explain how to calculate a cap rate and what it means for you. The next section in this investment overview is going to be your equity structure. So this one, and this is my typical structure, is a 90-10 split of the equity. 10% being coming from me as the sponsor, and then 90% coming from the limited partners or the other investors in the deal. The biggest thing to take away from the equity structure is how much really the sponsor is putting into the deal. If you see an investment deck where the sponsor is putting no money into the deal, you probably shouldn't do the deal. So the next thing to understand is the waterfall structure. This is where it gets a little tricky, but listen, because this is where some things happen that you need to really understand in a deal. The big thing you need to understand, in my opinion, is what does the bonus structure look like for a sponsor? Are you getting paid back first as the investor before this person gets that promote? For me, I always feel like there needs to be a preferred return first, a return of capital second, then the sponsor gets paid. So my structure is very simple, 70-30 split after return of capital. So that's how the waterfall structure works. The last section in the investment overview is going to be your annual projected cash flow. So right at the very top of this section, you'll see your average cash on this deal is 14%. So very simply, look at it from this standpoint. If I put $100,000 into this deal, I'm going to make $14,000 a year on the property. So then below that is the exit assumption. So typically I write to a 5-year exit on the property as we would hold it and then exit it in 5 years. On this example, we're basing the cap rate at 7.5%, showing that we will exit the property at $2.56 million. Below that is the IRR. So what the IRR is telling you is that at the end of the life cycle of this deal, when it all comes out in the wash, when you get all your money back, you'll be making an average of about 22% annually over the last 5 years of your investment in that deal. In year 5, when we exit the property, you would get back $241,000. Your $100K plus an additional $141,000, which equals a 2.41 net equity multiple. This is a real brief run through on this. If you have questions, reach out to me through the socials, email, website, YouTube, wherever. Leave a comment. Let us know. If you have any questions on this, we're more than happy to take a deep dive with you into this. It's very important to me that people understand this when they're getting involved in these investment deals. I don't want there to be any kind of misrepresentation of thinking what the deal was when this is the structure of the deal. So again, hit me up. Let me know if you got any questions. I'd love to walk through this stuff with you.